Hello and welcome to another episode of Smaulgld Subscribers Sound Off. We haven't done this show in a while. I'm happy to bring back Rhefn, who's going to talk to us about gold and the blockchain revisited. His latest article, Building Bitcoin's Gold Standard from the Bottom Up. We'll put a link below and you can follow along some of the thought-provoking content that is in this article. Now, I've noticed from the Smaulgld audience and also basically from checking out other gold blogs, Bitcoin blogs, that there is a set of camps, and they're very large. On the one side, you have people that are purely for gold or silver or both, and they view Bitcoin as a scam, a Ponzi scheme, something invented by the NSA, something that has absolutely no value, and eventually, in their view, it's going to zero. It's a very large camp in the gold community. On the other side, there are people who are Bitcoin proponents, maybe even Bitcoin maximalists, and they view gold as yesterday's news. They're almost Keynesian in their scoffing at Bitcoin, thinking that it's the barbarous relic, it's part of the Flintstones, and that the new gold is Bitcoin, the digital world, it's digital gold. And then you have another camp which is fairly large, which are people who like gold and silver and pay some lip service to Bitcoin. Many of the gold dealers may talk kindly about Bitcoin, maybe because they've set up a payment system where they could sell their gold for Bitcoin, but they kind of tepid on it, and they're not really proponents of Bitcoin. But our guest today starts from the perspective of a gold bug Austrian point of view who has not moved off of his love for gold and utility for gold in the monetary system, but also sees a very strong place for Bitcoin. So he's one of the few, there's not a large camp of people who are strong proponents of gold and Bitcoin. And Rhefn, welcome to the show. How are you today?
Hello, Lewis. Glad to be back again. I think this is the third time around.
Yes, it is. And this time you sound better than ever, and I'm sure this is going to be a great interview. So could you tell me the genesis? I know that this article, Gold and the Blockchain, this isn't the first time you've talked about this subject.
Yeah, the whole of my blog is actually a discussion of both credit and money. So one of my previous posts was from barter to Bitcoin, the theory of credit and money. So this is a play on Mises's theory of money and credit book from 1912. So, but I argue that credit actually comes before money. So local credit ledgers will exist before people need to go outside the locality and start exchanging with people who they don't know. So it's then that people invent money, which is to kind of eliminate the trust deficit in barter. So
let me interrupt for a second.
Yeah, sorry.
I know a lot of people view credit as a bad word, and you've just said that credit came before money. Can you give an example of how credit would have developed before money?
Well, it could develop really in two ways. So if you had, a more prehistoric and isolationist economy, let's say there's two people who want to exchange, they could do it by a credit ledger. So they mark down who owes what, and then when the favor needs to be returned, the ledgers can be updated. So if you go back to Sumerian history, for example, they had both money and they had ledgers. And I would assume that this is the same for the rest of Mesopotamia and for Greece and for Rome. But everybody really, when they talk of history, they talk about the history of gold and the history of silver.
Right.
But banking, credit ledgers and banking are identical, really. One's just that the original credit ledgers come before money, but then after money's invented, then you will scale a derivative layer for money,
Right.
which is banking basically. So it's a paper note or a bill of exchange or something that's specifically backed by gold and silver in the vaults. So this is the concept of full reserve banking, which the Austrians have discussed as an honest monetary system. The problem is that we've basically never had it. Banking will start out honest, and as soon as it's trusted by the exchanging public, then the people in power will start abusing that privilege. The privilege to issue money is it's the main monopoly you can have over any society.
So when you I'm going to just get back to credit, because when people think of prehistoric societies, they think of barter, and that the reason people came up with money was that barter was inefficient. And I get that. So I have eggs, you have wheat, you exchange it to, people think that came first, that was barter. People thought, well, that's unwieldy. Let's create a money standard so we can exchange a unit of, let's say, gold or silver for a certain number of eggs or a certain amount of wheat. But in the barter system, I think what I just want people to understand is there was a credit element to that. You may say, can I have some eggs from your neighbor, and you have nothing to give at the moment because the wheat isn't ready. And he says, sure, I'll give you the eggs now and you'll owe me the wheat next month. That's a form of extending credit, and that is pre-money, and that is a form of credit barter, correct?
Yeah, so localized barter is the most sustainable form of exchange. So you do this exactly like you said. So in classical Austrian theory, the moment you have a barter exchange, you have the double coincidence of wants, which is basically saying that if you're swapping a chair for a pair of shoes, say, that the chair seller has to want shoes and the shoe seller has to want chairs. So what a barter ledger allows you is it's a way to store your produce and then extract it from them in the future. So there's no physical medium of exchange involved in barter. It's a kind of a mental barter. So this, if you think about Bitcoin, it's basically exactly the same. So there's no medium of exchange in Bitcoin. This is what the Goldbugs on the Austrians say is it's a scam, because there is no physical medium of exchange. But this is true of localized barter and barter ledgers. You have to trust the ledger.
Okay, so this is very important. Let's go back to, and we're going to get to that again. Why did gold develop money as such? And why do the Austrians, at least up to Mises and Rothbard, think that that was the perfect way of transacting? What made the gold better than just the straight barter or ledger barter?
Right, well, I think that money's first and most important intrinsic quality is store of value. So, and this is an argument that's been coming up in the Bitcoin community about its ledger too. If Bitcoin is more of store of value or if it's meant as a medium of exchange. But first, money has to develop as a store of value, so it has to be scarce. So this can rule in most commodities really in the economy, because wheat is scarce, eggs are scarce, but you have these few intrinsic characteristics of gold and silver that have made them the standout objects as money. So they are fungible, for example. So if you try to barter a transaction of a cow and you had to chop it up, then obviously the dead cow would have less utility than the live cow. The same with diamonds. So not everything is fungible, and another characteristic is durability, so it needs to last a long time. So this rules out most foodstuffs. So to really, for money to be long lasting, you're usually looking at metals, which then brings up portability. So it needs to be easy to carry around and used as a medium. After it's been a store of value, it needs to start scaling as a medium of exchange. So you need something portable. So say if you're buying 10 cows with a ton of iron, or 10 cows with a gold coin, it's obvious that the gold coin will scale as a better money than the ton of iron. So really the most important intrinsic characteristics of gold is that it's scarce, very scarce indeed. It's durable, divisible, and fungible.
I would add to that desirable because of its look and its properties.
Yes, but again, that's another characteristic of money, as is that it's relatively evenly distributed over the earth. So that exchanging cultures on different continents, they most of them use gold as a common medium of exchange anyway.
That's why platinum never took off, because it was found only really in Russia. So they made their own coins and they exchanged them, I think, in the late 17th to 18th century. But that never caught on because the whole world did not have platinum.
Yeah, if everybody else desires gold, then platinum is only going to be a money of Russia.
Right.
So it's also about scaling.
So the Austrians then developed their theories around gold as money because gold was money based on the characteristics that you just gave. And they also added to it, I believe, the regression theory. Can you explain how that works? Why gold was considered money by Mises?
Mises basically said that any money that originates in the market had to have come from a previous use as a common good. So he said that money can't just it needed to be a physical commodity is basically what he's saying. For money or even exchange to have value, it has to be a physical commodity. So this is what the Austrians lean on heavily for a lot of their theory when it comes to money, which is this regression theorem.
Okay, so that theorem basically says that there is already a desirability in the commodity, a use for that commodity outside of its use as money or currency as a medium of exchange, and therefore that is basically their view of what money is, and the best money has been selected historically has been gold and silver. Now, let's move on to this is where Austrians of the old school would have a problem with Bitcoin, because Bitcoin does not have a pre-existing use for anything. But it sounds like you had that interesting theory about how it actually does, in the sense of it being part of a ledger, which kind of predates in a clunky way the barter credit ledger system, but updates that so it's actually quite efficient. So how does Bitcoin get around not meeting the definition of the Austrian school, the Misesian view of money, without having a pre-existing use or intrinsic value, so to speak?
Well, I'd compare it again to a local barter system in that until people start exchanging on the ledger has no value. Then when the first farmer puts a chicken down on the ledger, and then another farmer, puts a cow on the ledger, then all these items of value, which is, what humans exchange with, is added to the ledger. So the thing about Bitcoin is that it allows you peer-to-peer barter on a local scale, but you can also exchange on a global scale. So what Bitcoin in essence is a globally scalable credit ledger for peer-to-peer exchange anywhere, with no trusted central party or counterparty, which is unique, as far as I know, in human history.
That's right. And I think that is where people don't grasp onto that conceptually, because in a sense, maybe they've been told that money has to be and was always been gold or silver because it met those tests, and you can't neatly fit Bitcoin into all the tests. And I think my point of why I've caught on to Bitcoin is I don't need money to fit a test that's pre-existing, because people chose gold and silver and then they created the reasons why, as justification why they chose them. But if people choose Bitcoin for the reasons that you just gave, well, that becomes a reason for it to be money, and it doesn't have to fit the gold and silver test. Now, if we go through, can you give us kind of the historic overview of the increases in credit starting around the Middle Ages and up until the creation of banking, and then how that morphed into then sound money, hard money, and then credit bubbles? Give us a quick history lesson, please.
Sure. Well, after, the kind of history of civilization is an inflow of trade, the expansion of trade and the inflow of precious metals, and then at some stage the state gets too big and it gets too corrupt, and then it expands its empire and wars, and then the precious metals that flew in at the start of civilization start to flow out, and so they have to debase the money, which obviously makes them poorer in the end, and the civilization ends in collapse. Well, after the fall of Rome in approximately AD 500, so 500 years after Christ, then the early and high Middle Ages lasted 1,000 years, and in my opinion, because that nobody was really able to gain control over the currency and the money of Europe for that 1,000 years. Obviously, you had the Holy Roman Empire and you had the Catholic Church, who were in a kind of a death grip for control of Europe, but not really until it's called the so-called Renaissance out of northern Italy in the 14th and 15th centuries. But what you also find in that time is the invention of the double bookkeeping ledger.
Accounting.
So
that's modern
accounting,
right?
Yes. So this I've claimed in many posts as was probably the biggest technological invention in human history until then. So a double bookkeeping ledger allows you to have credits and debits, and so you can manage incomings and outgoings. So this is really the birth of the banking system. But money flows into bank vaults, and then this ledger is levered as a derivative of the gold and silver in the vaults is then spread through society, and the gold and silver coins become interchangeable with bills of exchange and paper banknotes, and this is the start of the blurring of lines between credit and money. And also in this time is the Protestant Reformation throughout Europe, which I also speculate was heavily backed by the Venetian black nobility, which were the money centers that had developed this early form of Italian capitalism. So they spread their tentacles. What Protestantism did was give kings, it's called the divine right of kings. So it's basically makes them a law unto themselves and above the laws of all their subjects. So the Reformation was really catastrophic for Europe in that it centralized, there were many wars. The 30 Years' War and the 80 Years' War were two massive wars in the Middle Ages that destroyed up to a third of some German regions in Europe. So it was really catastrophic. But out of it basically came the division between Protestant monarchs in the north and Catholic monarchs in the south.
And how were those wars? Didn't the advent of accounting or the ledger and credit help finance those wars?
It did. So the bankers funded, the monarchs. For example, I've read up a bit on the Tudors, and the Tudors were backed, and we apparently switched from common law to maritime law really with the Tudors in well, apparently Welsh Tudors, but they also ended the feudal system in Wales. So I have a special hatred for the Tudors. So then, because we have this divine right of kings, and you know the feudalism wasn't really a nation state, or if it was very local. But these national monarchs take things to national and international scale. So Henry Tudor, for example, controlled Wales, Ireland, and England, which was a big territory. So these nation states kind of turn into legislative and taxation gulags. So the monarch takes a monopoly, and then you have these money lenders then asking for this exclusive monopoly over money, which is the central bank monopoly and the license to print money.
And when did the first central bank come about?
Well, the first came about in Sweden, really, the Sveriges Riksbank from 1668, which was instituted under a Protestant king. Surprise, surprise. And then 6 years later, after the Glorious Revolution in England, when William of Orange came back and Protestantism was reinstalled in England, 6 years later, in 1694, came the Bank of England.
Now, here's a question. Now, we're looking at the birth of central banking. Prior to this time period, there had not been such a central bank, correct?
Yeah, there had been local versions, a lot of people talk about the tulip bubble and the South Sea bubble and the Mississippi bubble, but these were really early examples of local fractional reserves, fractional reserve banking.
Okay.
I think you also had the stock exchanges starting in Holland around the same time as the tulip bubble, and I think the South Sea bubble was that French or English? The Mississippi bubble, I think, was
Mississippi bubble was French.
Sorry,
that was John Locke, right? That was the guy.
John Lawyer.
John Lawyer.
The South Sea bubble was, I think, connected to the London Stock Exchange. So it's at this time that you start to see the first experiments of fractional reserve banking. But the
What do you mean it was the beginning of fractional reserve banking?
Well, these popular myths in history, really. For example, the first one was the tulip bubble, and then you had the South Sea bubble and the Mississippi bubble in the early 18th centuries. So these were the first examples of fractional reserve banking, and they developed really in lockstep with stock exchanges. The Dutch stock exchange started, I think, just before the tulip bubble, and the London Stock Exchange started just before the South Sea bubble. So this is the history, really, but of not mass scale, but localized fractional reserve banking, which built these bubbles that then popped, and they've become enshrined in myth and history. But the first real the first central bank was instituted. It was the Sveriges Riksbank in Sweden in 1668, which was set up by a Protestant monarch, obviously. And then 6 years later, after the Glorious Revolution of 1688, when King William of Orange brought Protestantism back to Britain. It's 6 years later, and 1694, when the Bank of England is instituted, and within 50 years really of the Bank of England being instituted is the Industrial Revolution, which lasts roughly from 1750 to 1850.
Well, hold on a minute. You mentioned both times there's some connection that I didn't quite catch it, between the banking and Protestantism. What is that connection?
Well, it's this divine right of kings that Protestantism gives to
Ah,
the monarchs after the Reformation, really, which means they can legislate and tax, their citizens in a centralized gulag of legislation.
but
So,
didn't
th
the Catholics have something similar in the Vatican?
well, they did, but the history of the feudal ages really is local barter ledgers and gold and silver coins. So I don't think the Vatican really had as much control over feudal Europe, or nowhere near close to the control over
Right.
feudal Europe
That
as
that a
the
king.
Protestant monarchs.
Exactly.
Yeah.
Okay.
So yeah, once this colony of legislation and taxation is in place, it's then that the moneylenders can come in and lend kings money to fight wars, and then what they're really after is the monopoly of central banking, which is the monopoly over currency, issue of currency, and the license to print money, as it's been called.
Now I'm going to
So
interrupt here because at the time there was gold and silver, and this gold and silver in no way, shape, or form stopped central banking, did it?
no, it was basically hoarded by the banks. So what they do is they hoard up the commodity, and then they use the ledger to rig to print additional currency, so they can buy up all the property. And that's really where the industrial revolution comes from, and where I have started to break from the mainstream of Austrian thinking, and that this classical liberal Whig theory of history, which states that the history of of everything is total progress and everything gets better. But I argue, I'm starting to argue that it was the Bank of England really that printed the Industrial Revolution and this enormous population boom that happened in England. Where I think the population of England went from 6 million to 24 million in 100 years, from 1750 to 1850. So, and I also argue that industrial mass production capitalism is a derivative of the Bank of England, because the Industrial Revolution originated in England first. So this I would suggest goes against Austrian orthodoxy, who think that the Industrial Revolution was the product of the free market, whereas I don't think you can call the Bank of England a free market if it's got a monopoly over the currency issue.
But wouldn't you bring that forward to the 20th and 21st century in the U.S. and then the Western and Japanese central banks? Same thing. Whatever progress we have economically is more a result of central bank intervention than free trade or free markets.
Yeah, well, the history of America is especially interesting in this regard. You have the American Revolution and the throwing off of the crown, but through the 1800s, you really have trying to get the central bank back in place. You have the first national bank, and I think you had the second national bank, which Jackson killed.
Right.
Coincidentally, Trump has a picture of Andrew Jackson up in the White House, if that gives you any clues. Then I think the Civil War was instigated to centralize America, and then
clearly,
and then with the robber barons and the centralization of credit through J.P. Morgan that started to happen in the second half of the 19th century in America. I think it was only a matter of time before the Fed was instituted, which it was in 1913, and by then really the central bank template of the Bank of England had been transported to France and Germany and America for the start of the Great War, which the bankers needed to fund to basically destroy it. Really destroyed Europe.
And basically, since 1913, we've had, you would have to say, the most two global wars, World War I and World War II, and then just a series of wars ever since then.
Yeah, the First World War was started on a gold standard, but they came off after
Right.
originally the war was only meant to last till Christmas, and that was basically because of the gold supplies. So what they did was came off the gold standard, the bankers printed the money, the people got shot in France or Belgium, genocidal trench warfare, and the domestic, it was really a kind of fractioning of the traditional family unit in one way, in that the women had to work in the munitions factory throughout the wars. You had rationing for the people, and you have this small band of capitalists and financiers who got obscenely wealthy off killing people.
So, I keep coming back. This is a revelation to me because I keep hearing people say, we just need to go back to the gold standard. Everything was good under the gold standard. And I'm not sure how it was, because the governments found a way basically to hoard the commodity, fix the price of gold, and cheat. And I'm not sure how that was any freer, because if you have...
The historical gold standard was fractional at best.
Right.
The Industrial Revolution kind of proves that to me, that it wasn't a true gold standard, and it just got more and more debased over time. But still, gold did put a chain on money printing. So
yes, okay, put a chain, but it also, for people who hold gold today, if you were to go to a gold standard, then the price of gold, maybe you would get a fix at a higher price, but then that would be it. You would no longer be able to, quote, protect yourself, because it would now be in the government's hands, and they would tell you gold is X per, and there'd be no point in holding gold.
No, but if they ever did go back to a gold standard, it would kind of destroy the welfare and warfare index, and that.
Yes, because they limit them.
You could revalue gold, but you can run deficits, and then you suddenly couldn't monetize deficits. So it would still be a chain. As bad and as inept as the gold standard was, it was truly a fractional gold standard, but it was still a million times better than what we've had since 1971.
Okay, so then they got rid of it. Well, we got to go back a bit now. After World War I, what happened?
So you had the 1920, the short depression of 1920-21, when the credit shrunk after the war, and America was really the world's only real power after World War One. They eased credit through the 1920s, which is remembered to history as the Roaring Twenties, but was really the rigging of interest rates lower and the extension of credit, and especially consumer credit. So in the 1920s really was the first time that people could borrow money from the bank. So once you borrowed money, you're then in the banker's pocket when this bubble crashes.
They also borrowed money to buy stocks, correct?
They did. So by 1929, Main Street investors were, loaded to the gills on debt and leverage, and as I think Mises put it in in the 1920s, it's going to be a massive crash, and that happened in 1929. And so what happened then was a massive credit unwind, triggering of bank runs, and really a generation of Americans lost their property to the banks when they couldn't pay back the debts that they'd accumulated during the 20s. So then in 1933, I think, came the Emergency Bank Act, and this was really the coup de grace by the banks when they made gold illegal to, well, they say confiscation or make it illegal to own, but basically they made it illegal to use an exchange or to hoard, and that you had to turn your gold coins over to the government. And this is Executive Order 621, and issued by the progressive saint Franklin Delano Roosevelt. So this is one of the biggest happenings really of the 1930s, and it's the removal of gold out of circulation, which is also coincidentally in the years leading up to the Second World War, which needed a lot more money printing to finance the destruction of Europe for the second time in 30 years.
And what happened during that time period also was, how were the so-called New Deal programs financed?
Um, well, I would
Were they credit
assume.
financed or were they?
Yeah, well, the gold was out of circulation, so the Fed could really print what they wanted after that. So yes, it was, but it also, well, as I put it in my essay, by 5 years of 1929, America's debtors who couldn't pay back their debts had lost their property to the banks, and America's gold savers or money savers had lost their gold, and then they devalued the dollar 40% against gold. So
Okay.
when people talk to me about the Great Depression was obviously created by the bankers, and it robbed both savers and debtors.
Right. So now World War II happens, the war ends, and they institute the Bretton Woods system, which reluctantly, to the Keynesians, included this pseudo gold standard whereby the signatories to the agreement, the central banks, could take their dollars to the United States and exchange them for gold. Now, gold is out of circulation now, has been out of circulation, people using it as gold. But amongst banks, they have this agreement where supposedly the world's economic system runs on dollars that are, however, indeed backed by gold. How did that help the central banks? And how did it limit the central banks? And did it help the average person in any way, shape, or form? Because they had to set the
Well,
price at $35 in 1934, and they kept it there during the entire period that the Bretton Woods Agreement was in place from 1944 to 1971.
well, they had control of the credit, so credit really became money in that gold and the dollar were not really interchangeable anymore. So it did allow them to print more credit than they had gold, which is when the French, de Gaulle started to call them out send the warships to get the gold for the dollars. But it did allow, it's called in history the post-World War II boom, which was the 50s and 60s, although going through the 60s, it was obvious that with the Vietnam and other stuff going on that the peg to gold wouldn't really last, and that's really what happened in 1971 when there was essentially a run on the I'm not sure if it was the Treasury or the Federal Reserve System.
It's the Treasury. The Treasury. The Treasury held the gold, and the central banks would bring their Switzerland, France, any country could bring their warships over and collect the gold. The Fed never owned any of the gold. That was all. It's still the case today. The Fed owns no gold. It's all held supposedly by the U.S. Treasury, and that's why Munchkin, whatever his name is, visited Fort Knox, because that technically belongs to the U.S. Treasury.
But you know that gold, that order 6201, it says for you to turn your gold over to local Fed banks. So I was just wondering, if it's official history that it's at the Treasury, then
yes, it is at the Treasury. but the system, the banking system, what happened was, I believe, the Fed has a note, I think at a certain price, of the gold, but they don't have physical ownership of that gold. It's supposedly with the U.S. Treasury.
Oh, okay. Yeah, so
and by the way, that's the Federal Reserve is the only central bank that isn't run by the country, isn't owned by the country. Like the Bank of France, Bank of England, Bank of Swiss National Bank are supposedly owned by the country, whereas the Federal Reserve is not owned by the country, or it's a private bank, and it's not owned by the Treasury.
This is what they say, anyway.
Yes.
Anyway,
yes. Let's not get into that. That's a separate issue.
That's a whole different story. Yeah. So 1971 really was when Nixon had to break this chain to gold, and so he did. And then out of this, then, obviously I've discussed through this that the banking is a derivative ledger of gold and silver. So they are eternally intertwined, banking and gold. So even after, making gold illegal to own, as they did in 1933 or 34, they still have to manipulate gold lower. So they developed this futures system which is
Oh, before that, they had the London Gold Pool to try to keep it at $35. You're talking about now
yeah, through
after
the
Bretton
60s.
Woods.
Yeah,
Yes. Okay.
yeah. After 71 now was the development of the gold futures system, basically to rig the future price of gold and silver lower. Because again, I think it was December the 31st, 1974, when the American government made it legal again for American citizens to own gold.
Yep.
So it's kind of then that this futures derivative system starts to try and marginalize out gold. But, you know, in the late 70s, for example, from what I've read, I think that things could have been quite close there to a return to precious metals, you know, the Hunt brothers debacle. And, you know, it was really, it depends which way you want to think of him, Volcker and his rate hikes that really saved the dollar. So, you know, he's a hero to some, and he's probably a villain to me in that he's perpetuated this system 30 or 40 years past what it should have been.
Well, I understand when Volcker was doing his interest rate hike and it was having no effect on inflation, the economy wasn't getting better. Reagan had set up a gold commission, and Ron Paul and Lou Lehrman were in charge of that, and it was to examine whether it made sense to return to a gold standard given the decade of stagflation, the deficits, and so on. And it was really only not adopted and called off because we had a break in late 1981, early 1982, where the U.S. economy really started to pick up. And that's by 1984. It was morning in America, and the U.S. won on albeit a credit binge boom, but the economy had finally gotten out of a 10-year doldrums, and they abandoned the concept of the gold standard, or even going back to a gold standard as Ron Paul and Lou Lehrman had.
And you know, this is really the time that oil replaces gold as the commodity money, because you know, even after severing the gold standard, they really need something to back their currency. So it kind of becomes oil then, and then this is the rise of, you know, the petrodollar.
Yeah, 73, 74, they created the petrodollar agreements. They stayed in place. The problem with the petrodollar agreements initially was that the OPEC then decided to do oil embargoes because they realized that they were just getting dollars, and that was a problem all through the 70s because there were two oil shocks, 73, 74, and then one in 78, 79, where they did an oil embargo. And that meant, like when you were talking about earlier in the interview, the thing about gold was evenly spread. Well, in this case, the oil was all basically in one place. For the free world, Russia had its own oil, but they were part of the USSR bloc. But the Western world was relying on the oil largely that came out of Saudi Arabia.
I've also, you know, read some theories that Kissinger told the Saudis to quadruple the cost of the oil, so that, you know, the gold, the oil would more back the dollar, if you understand what I mean.
And it also would help the Saudis get paid for, get more money for their gold,
and
too.
They could then recycle their oil purchases into treasuries, which is basically propped the dollar up. So
yeah.
I think, you know, that the oil embargo and the spikes of 74 and 79 was scams, really, to just make it more expensive for the average person, and so they could perpetuate this petrodollar system.
Now, during that time period, though, there was a significant rise all through the 70s in gold and silver.
Yeah, this was basically the decade when money printing went nuts. So if you look at England, for example, they had to go for a bailout to the IMF in 1973. You had the stagflation 70s. You had the winter of discontent. You had the 3-day week. You know, you had electricity on 3 days a week in England in the 1970s.
Oh, England was horrific, far worse than the United States recession.
And this is a, you know, a first causal fallout from severing the link to gold. It was batshit insane money printing, and it's never really stopped. So this development of futures at the same time has kind of mirrored this financialization of the whole economy, in that, you know, how many ounces of paper gold are trading on the COMEX now to to every ounce of physical that you can stand for delivery. It was over 100, wasn't it?
Well, it fluctuates, and it's the same with the LBMA. It's the same with any trading of any commodity. They're trading derivatives in far in excess of the amount that exists, and that just seems to be the way it is.
Well, this is the only way, because as I've said, banking is a derivative of gold and silver. So the only way that banking has value really is to try and manipulate gold and silver lower. So they're eternally intertwined. So which is why I also argue that gold and silver will be the last things to skyrocket, because they are the ultimate, canary in the coal mine of the failing of fiat money. Even still now. Gold and silver are the kryptonite of the banking system. You could think of Bitcoin as another kryptonite, but it's more because they are intertwined, and because banking has always been tied to gold and silver, that they'll die trying to rig it. Whereas Bitcoin, so now, a part of my essay discussed that the real battle going on at the moment is not between gold and fiat, but between fiat and Bitcoin. So it's a battle not between money and credit, but between credit and credit, and which credit system is going to be used to revalue gold and build the new gold standard.
Now explain that, because that's where people don't see the value in Bitcoin. Repeat that, because most people think that if anything's going to happen, it's going to happen with gold, and you're saying this is going to be a credit battle involving Bitcoin.
Yeah, so, and this is one of the best things about Bitcoin. Is that it's not a derivative of gold and silver. So it's a credit system that doesn't derive its value from gold and silver. So it's not in competition really with gold and silver. So Bitcoin has no interest or incentive in manipulating the price of precious metals. It really has the only incentive to openly value them on Bitcoin's blockchain. So this credit system is a completely different type of credit system to the centralized one we have. So decentralization really is, I think, the best thing for gold, in that gold is freed from politicization and rigging and manipulation, and this is what Bitcoin offers gold. It offers a completely astounding decentralized global gold standard. So the gold bugs should love Bitcoin, but they obviously don't understand it quite yet. So I think this is quite a good avenue to go into in how roughly gold and Bitcoin will work on the blockchain.
Okay. How will they interact on the blockchain?
Well, so in my essay, I said that the price discovery of that the gold and Bitcoin would exchange at the margins. So this is your average gold coin dealer. It could be somebody who's exchanging gold or silver for Bitcoin, or it could be specific kind of gold vault businesses like Vaultoro or Gold Money.
Okay.
So if you buy and sell using Bitcoin, you're putting it on a different gold standard. So it's moving from being priced in fiat really to being priced in Bitcoin, and this is quite a slow game that might take a few more years. But in my essay, I list the amount of bullion dealers that are now starting to accept Bitcoin, and which I got really from one of your tweets.
Yeah, well, it's pretty much all of the online ones. You got AppMex, Bullion Star, Gold Money, GoldSilver.com, JM Bullion, Money Metals Exchange, Provident Metals, Silver.com, Shift Gold, Sharp Pixley, and Amagi Metals. That's pretty much all of the large ones that, as we talked about at the top of the show, are not, other than Peter Schiff, who openly does bash Bitcoin, but most of these gold and silver dealers are try to be neutral on it. I think goldsilver.com, which is Mike Maloney's, he tends to give a shout out to cryptocurrencies. But I think a lot of this is because I don't think they're seeing it the way you are. I think they're just seeing it as a commercial sense. There are people with Bitcoin who have money. They may take those Bitcoin winnings and buy their product. But you're actually presenting something a lot more, showing that Bitcoin is a natural ally of gold rather than just something you can make a few dollars off of selling gold to Bitcoiners.
Bitcoin is even better than that in that, because Bitcoin is scarce and there's only 21 million units, and that it's generally gone up faster than gold. If you're a gold bug and if you buy Bitcoin and it goes up 10x, then you can spend 10x of your 10x of your previous purchasing power in dollars to buy 10x more gold, which takes 10x more physical gold out of the system and starves, the bankers of the only thing they really can't rig in the long run, which is the underlying commodity itself. So, Bitcoin can be used as a trading platform for sucking more gold out of the system. But, as I put in my essay, roughly the three steps towards the decentralized gold standard is that these bullion dealers start accepting Bitcoin as a means of payment first. But step two is that they start holding Bitcoin as a store of value as well as a means of payment. So they accept Bitcoin for gold, but then they hold the Bitcoin, instead of cashing out back into fiat, which is, it's not happening at the moment, and it might not happen for a while until, Bitcoin goes up so far that these gold bullion dealers figure out that it's better off to hold the Bitcoin than to, hold your inflating fiat, But once this part has also been arrived, so when they're actually holding both gold and Bitcoin, so your coin dealer will have his hoard of gold, but he'll also have a stash of Bitcoins as well. It's then that this exchange then has an incentive to start paying his employees in Bitcoin. He has an incentive to start paying for the metals from the refiners and miners also in Bitcoin, and they have also have the incentive to accept it. So it's kind of the hyper Bitcoinization of the gold industry.
And it's also taking this completely outside of a fiat standard and a central banking system.
Yes. So, for example, Voltoro, I think last month they traded over 200 kilograms of gold. That's just one exchange. So there's 200 kilos of gold backing Bitcoin's blockchain. Now, if you imagine 1,000 or 10,000 of those kind of exchanges, then you'll have hundreds or thousands of tons of gold working on Bitcoin's blockchain. So that they're backing Bitcoin's blockchain, but Bitcoin also offers them, it offers the gold's arbitrage trade, and this could go over the world. So it's basically, it allows gold miners, refiners, and dealers to connect to Bitcoin wherever they are, and then say you have a scarcity of gold in one part of the world and an abundance of gold in another part of the world, then the Bitcoin's blockchain allows the gold, in a lot of gold, to travel to the place where the gold is scarce. So if you think of Bitcoin like that, it kind of helps distribute the gold ownership throughout the world more equally. And it also incentivizes, if I say in my essay that because Bitcoin will be exchanged for gold and silver and every other commodity, that Bitcoin will go up faster in value than gold. So that kind of incentivizes large gold holders, such as central banks or insane genocidal crime families, to start coughing up some of their physical gold so that can be reallocated, to other people that want gold. So even I say it's this is the price that gold will have to pay, in that it has to continue to play second fiddle to a credit system. But this is a far more benevolent and enriching credit system than the one we've had. And no, I call the free gold concept I discuss is really about depoliticizing gold and freeing it. And this can really only be done in the digital world we live in by a ledger. So the history of money is also the history of credit, and it is a thing I think is underappreciated by most gold bugs and even Austrians.
So if you have this develop, and this isn't an initiative of anyone's. This is just what you think is what is starting to happen and will happen organically.
Yeah.
Okay, and once it happens, where does that leave the average person in terms of how they store wealth and transact?
Well, 90% of your exchange might be through Bitcoin, so obviously you're gonna have reserves of Bitcoin, but you'd be stupid to only have reserves of Bitcoin. I don't think there's any doubt, except by historic ignoramuses, that gold and silver are still important. And I hold, even though I'm a Bitcoiner, I also hold gold and silver because Bitcoin might go down. The history of gold and money are eternal, but credit systems have never been eternal. This banking system has lasted this last 500 years, but I don't think it's going to last another 500 years. So, credit historically has been used to centralize money, but when civilizations and credit systems come apart is when gold and silver get revalued. And then they can start the journey back towards decentralization until the next credit system comes up, and then they centralize up again. But Bitcoin really allows a credit system to decentralize gold ownership, hopefully to billions of people. And so it really just becomes a question of education. Then you have to educate the populace on why they need to hold gold and silver reserves. That their intrinsic characteristics, the history, everything's going for gold and silver. They've got the 6,000 year track record. So everybody should hold gold and silver. And I think, in these financial panics we're going to see with the dollar and the yuan and the ruble and everything, that gold and silver are bound to be revalued upwards. And really the only question is left then is, which credit system are you going to use to run the gold standard? Do you want the centralized one controlled by crime families, or do you want a decentralized one that that distributes? It's really about this distribution of gold ownership, I think, in the hands of a public and not in the hands of these banking families.
Right. So in a sense, what you're talking about is a gold standard for everyone, as opposed to the central bank gold standards, which you say are better than just credit standards. So as we wrap up, are you following, if at all, any type of metrics to see this become a reality? What are you looking at this to see how this is progressing? How long do you think it'll take?
Well, in my post, I say that the fiat system is really in charge. If you look at Bitcoin adoption versus fiat adoption is 100% in nearly every country on earth, while Bitcoin adoption might be a fraction of a percent in most countries on earth. So this is not going to happen overnight, and what I think is that it's going to be highly dependent on the meltdown of the fiat financial system, because that is the trusted accountancy and credit system of the public currently. But what I think is also inevitable is that people are going to lose trust in this system. And as I've written in past posts, I think that's going to happen with the millennials first. So if you look at Bitcoin adoption demographics, then it's heavily concentrated among the millennials, while the boomers are still gold bugs, and they still have bank accounts and watch television, and everybody tells them that this system is sustainable and that the pensions are safe.
Exactly. Now go ahead.
The boomers have no interest in Bitcoin or in this deflationary credit system, whereas it's the debt-ridden millennials really that will drive mass adoption of Bitcoin, at least for their generation. But I think the boomers will have no choice in the end but to join up with the Bitcoin ledger as the pensions and the purchasing power implodes and priced in fiat.
Right. So what I wanted to do is just close off by reading a quote from your piece here, because it does sound like there are people that have their they think the world would be a better place if we all just went back to the gold standard. And what you're saying is you were better off not heading in that direction, that centralized banking system, even if gold is a part of it. Here's what you write. For the gold bugs who persistently bang on and wet themselves on hearing any mention of gold and of going back to the gold standard, do you really want to maintain the system whereby the world's central banks hoard and control all the world's gold reserves with your paper and derivative currency subject to overnight devaluations and general manipulation and debasement that will inevitably happen with a trusted and secretive counterparty and middleman? That is the history of banking. So the point being here, which you make very sharply, is gold in the hands of central bankers is still gold, but it's still in the hands of central bankers. And what you're saying is that Bitcoin is a way of going onto a gold standard and decentralizing this process and actually giving people economic freedom. Am I saying it correctly?
That was pretty much perfect.
Okay.
The thing about gold is that unless it will be exchanged by all of the public, and I think that's unlikely in a digital economy, then gold, you also need an accountancy system, and this really has been history too. It goes back, right to the beginnings. So it's a balance between money and credit. So credit does some things that gold and silver cannot do, in that it's not a medium of exchange, for example, and you can send it anywhere on earth. But there's also things about gold and silver that you can't do with a credit system, and then they haven't been designed so. So you can still do physical face-to-face transfers with gold and silver coins, which you can't do with Bitcoin because there is no medium of exchange. So it's a balance. I've also written about the decentralization of credit and currency, and that comes in 3 layers. So gold and silver would form the base of an inverted pyramid of assets. Then you would have Bitcoin and blockchain as the ledger system, and then you would have a local currency paper derivative, which would probably be backed by Bitcoin, to exchange as a local means of exchange. So I've also done a post on local banking and the economics of how to set up a local bank and how to start issuing currency and managing your currency reserves and everything. So I think this is the future of and I won't call it money, I'll call it exchange. So you have money, credit and currency. Money is gold and silver, credit will be Bitcoin and its blockchain, and the currency will be local paper substitutes. But because they're local, they can be any color, design, pattern. You can have local figures on your banknotes. You can have anything you want, really. So it allows diversity then of local banking, which is, I think, far more desirable than the current national currency systems that we have today.
Couldn't agree more. Gold in the Blockchain, revisited by Rhefn. Please check it out. I'll leave a link below. Thank you very much for joining me today on the Smaulgld Subscribers Sound Off series.
Thanks very much, Lewis. Pleasure as always.